Hello and welcome. I am Martin Sandbu. I'm an economics commentator at the Financial Times, and I'll be hosting this event. Thank you all for coming. This event is part of the York Festival of Ideas online. I'm very pleased to take part, even if it's virtually. I've been at the York Festival before in real life, uh, and it's always an excellent festival that continues to enhance York's reputation as a city of ideas and innovation. And I think it does so even more this year because from the numbers, about half of you are in York or in the York area, and half of you elsewhere in the UK and in the world. So thank you for joining us, and I hope you'll also enjoy some of the other more than 60 online events that are part of the program. Um, if you are watching live, this will also be broadcast later or put on the internet later. But if you're watching live, you can ask questions using the Q&A button on your screen. You can do that anytime through the talk, although it will be the last portion of the hour when we'll actually address the questions. But ask them as you think of them. If you have any technical issues, if you lose connection, you can reconnect using the original link. And as I said, we are being recorded, so you'll be able to watch again, but it also means that your questions will be recorded too. Now, it's a huge pleasure for me to host and introduce Danny Blanchflower, who is a great economist. He's a professor at Dartmouth College and at the University of Stirling. He is also a former member of the Monetary Policy Committee of the Bank of England, and he is an expert on labor markets. His latest book is called Not Working, Where Have All the Good Jobs Gone? And he uses a methodology he's devised called the Economics of Walking About to try to understand what's really going on in the economy. And you will have noticed that a lot is going on at the moment because of the pandemic. And unemployment is a particular measure of just how bad things are. That is what Danny will tell us about. He knows the data better than pretty much anyone else. So I will just hand over to him and let Danny take us through what we can know at the moment about how bad things are, and then we'll have a discussion about where we go from here.
Martin,
Danny, over to you.
thank you so much. Hopefully everybody can hear me. Martin, you can hear me? Yes. Thank you. Well, actually, last year I came to the York Festival of Ideas, and in fact, I talked about the book. So today I'm going to try and share my screen, and I'm going to talk to that, and hopefully I can share the screen, and then I can go to the slideshow. Good. Okay, well, I'm a fisherman, so I like to fish. So that was this week's latest catch, a snook. Let me talk about what's going on here before we start. So this I call the economics of walking about. And it's actually, because we're not doing much walking about, it's now the economics of walking about the internet. And I've been running classes at Dartmouth this term, and I think I would like to just rephrase it another way and call it, well, what the heck is going on? And that's what I'm going to talk about, how hard it is to understand. But let me just sort of put this in context. I really talked about the economics of walking about first in early 2008 as an indicator of what was coming that other people didn't think was coming. And let me tell you a couple of stories. And I kept thinking early 2008, particularly at the turn of the year, that a big recession was coming. And a couple of stories which have set us up for where we're going. So I was in a cab at the beginning of January 2008, driving down Oxford Street. And I said something, and the cabbie said, I know you, you're Blanchflower. And he said, I've been driving up and down Oxford Street for 30 years, and I've noticed something this year that I've never noticed before. And I said, I have no idea. And he said, what I noticed is actually people are walking up and down Oxford Street, and they don't have any shopping bags. And I thought about that, and that seemed kind of interesting. It turned out that was a pretty good indicator that retail sales was going to fall. And I did an interview and I talked about that, and somebody else called me up and said, I run a company that services tires for delivery trucks, and we take the service on for the company. And he said, and what we have is we have tachometers on the delivery trucks. And he said, we noticed something as well, consistent with what the cab driver told you, which is that from the early start of January 2008, these delivery trucks started to deliver things less, drive less. So that sort of sets us up to what the economics of walking about is about in this Great Recession. One more thing I should add is that today we had data from the ONS showing a 20% drop in GDP in April. But actually, it turns out we had problems in 2008 of that kind as well. And let me explain. So all through that year, I kept saying that a recession was coming. And I got thrown for a loop because in July 2008, we got data from the ONS, just as we did today, nothing like the -20. We got data saying that output in the UK in the second quarter of 2008 had grown by plus 0.2%. And that absolutely threw me for a loop. Well, it turns out that was wrong. And these data went into revisions. And so the revisions ended up today. We know that the second quarter of 2008 is around -0.7, not plus 0.2, nothing like the -20 that we got today. But the point of the story is that much economic data at turning points gets revised. The great benefit of doing the economics of walking about, which is looking for things out there in the world and trying to understand what's going on by talking to people and looking at stuff and trying to interpret things, is really where you need to go. And I think the evidence that I'm going to talk about today, and Martin's going to talk about as we go on, is that the economics of walking about matters. So I'm going to just go through a few slides, not spend a huge amount of time, but let's just go through this, just for links for people. I've written half a dozen, I think it's 5 there, op-eds that are relevant to this, to try and set this out in more detail. Technical stuff is on my website, and if people want to write to me, I'm happy to respond and send things. I've used this many times, and I think this is kind of central to what we have to talk about, because where we're sitting is in the depths of a slump. We saw that in the data today. But in 1930, Keynes, and I've used this many times, I've written a couple of columns in The Guardian about it, and others have as well, about this very important quote. And Keynes talks about, it's not so much the crash. So think, this was written in 1930. It was written after the 29 crash and relevant to what happened in 2008, another great financial crash. Keynes says it's not so much about the crash itself. It's not, of course, really about the duration of the acute phase of the slump, but that of what he called the long dragging conditions of semi-slump, or at least subnormal prosperity, which may be expected to succeed the acute phase. And in some sense, that's what Martin and I are really trying to think about, which is we need to try and understand the crash. It's not hard to understand that we entered into lockdown. And in fact, the NBR dating group has already called the US being in recession in February 2020. If you look back to 2008, it took them a year to call that the recession started in December 2007. So there's not much dispute about the crash and that we've been in lockdown and that this has had a big effect. The real question is, what does the recovery look like? And I suspect, and I was talking to the president of Dartmouth yesterday about recovery. He's a mathematician. It's a kind of funny, you take the square root side and you turn it round. And I think what we're going to see is something of this kind, where we have obviously the drop. There will be a pickup as things open, but then the question is, what after that? Are we going to end up in a year or two's time with high unemployment? And we got a forecast from the OECD this week, which gave us 2 scenarios, both of which were horrible. One scenario was that the virus comes back hard in the fall, and one that it doesn't. But both of them give you numbers of the unemployment rate in 2021 of 9 or 10% or so. And just to understand, that would be where you would end up in a couple of years' time. We didn't ever get above 8% in the Great Recession. So this is about trying to get to understand where things are. Turns out in the United Kingdom, it's really hard to work out what's going on, partly because the data is poor and it's very lagging. I'm going to talk a bit about the unemployment rates, which is Martin introduced to me. We don't really have any data from the US or from the UK at all past February. And if you look in the February data that I just went and looked this morning, you can actually get month by month data. The latest data for the UK tells us that the unemployment rate is 3.7%, which we know isn't true. And so we have real problems in working out what's going on. We actually have really good data for the US, but that's pretty hard, and I'll show you in a second. So we actually have in the US weekly data of the number of people who've claimed unemployment insurance. We've never seen anything like this. In the period, so the top number, March 40, it averages out at about 280,000 a week. And in the US in 2008, the unemployment rate went to 10%. So this is the number of claims made every week in the United States. And you can see since the middle of March, something like 43 million people in the US have claimed unemployment insurance. So we know something about that. We know about people claiming unemployment insurance. It turns out we have no clue at all about how many people have been hired, how many people have been pulled back. And so that's a big problem. And if we take the US data, so we get data for the US for May. In the UK, as I said, we have data for February, it says 3.7. Well, this is the data that we have for the United States, which is just for you to see that already the unemployment rate is miles above where it was in 2008-9. The one surprise was that last week, there was a big decline in the unemployment rate. And economists didn't actually expect that to come and expect it to happen. The economists are walking about, told them, go back one, told them that there was this continuing rise in unemployment insurance. Turns out in the data, if you see the line that drops back, unemployment fell back, but still to catastrophically high levels. And the black unemployment rate is especially high. How am I doing? I think I'm doing okay. So it turns out that it's really hard to work out what's going on, even in a place that releases data. And in fact, the data was released on Friday of last week, and they gave people like me the underlying data on Monday. In the UK, we should get the underlying data for May sometime at the end of December of this year. In the US, it took 4 days. In the UK, it'll take 9 months. That's not very good, is it? We don't really know what's going on. So here's a problem which we have to deal with, which is that everything has changed. So it turns out that the interviewers in the Bureau of Labor Statistics in the US, basically the offices are shut. They can't do face-to-face interviews. So they have a problem, which it turns out that the actual unemployment rate, which was defined as 14.7% in April, was actually 5 percentage points too low. But the BLS couldn't bring themselves to actually change the numbers. So the government says, aha, the unemployment rate is 14.7%. But if you read the actual data and you look at the data that they send us, it turns out that that people were actually classified as employed absent from work, so-called other reasons. They were told to classify themselves as unemployed, but they classified themselves as employed. So this really matters. It really matters because it literally, in April, it took the unemployment rate from 14.7 to 19.7. And in April, the fall down, it adds another 3 percentage points. But we're in a complete mess here. We're in a complete mess because we don't know how to do this. We've never seen anything like this. And it turns out what really matters in this period is that not only are the unemployment rates themselves especially high, Martin and I think we're going to talk a bit later about the fact that not only is that bad, but the worst part of it all is that it especially applies to the weakest groups. So think of minorities, the young, the less educated. And not only are their unemployment rates especially high, it turns out that this adjustment is especially high. So for example, you add 5% to the overall unemployment rate. The BLS doesn't tell you anything about that. It simply tells you about the aggregates, and people like me have to go into the data and work out that actually black unemployment rates should actually be raised by 7%. So this is really hard to work out what's going on. And it turns out in this period of what the heck is going on, even in the surveys, so the survey we all use, here's the survey. Well, it turns out that the survey responses, so if somebody gets targeted to please respond to the survey, well, it turns out we've never seen anything like this. The response rate to the survey went from 85 to 67 in the space of a month and a half. So we're really in a position where what the heck is going on is a really big problem. And that's why you need the economics of walking about. Even if you take these data, we're in a completely kind of new world here. And if you take the data just to get us in the world where we are, if you take these adjustments for the United States, and it looks that I think the UK, we will see it going there. It'll have the highest unemployment rates other than the United States, and it will apply differentially across places. So just to shock you, if you take the data for April 2020 and you make this adjustment that I've talked about, which is not the official data, but it is in the data, what you end up with the states like Nevada. Nevada has a 33% unemployment rate. Say that again, 33% unemployment rate. Michigan has about 27%. That was in April. New York has 26%. We just got the data, as I said yesterday. And those numbers are a little bit lower, but I'm not sure I believe them. Nevada still has an unemployment rate of 30%. 30%. So the unemployment rate, even across all of these places, is higher than the aggregate unemployment rate in the United States is higher than it's ever been since 1939. It's interestingly this week, Trump wanted to celebrate the change in the data and said how historic it was, and it was historic. It's the worst. It's the worst, the second worst labor market data we've seen since 1939, after the first worst, which was a month ago. So here's a kind of economics of walking about that we're having to try to do, because the data themselves aren't very helpful. We don't have good data like this in the UK, but fortunately the US is starting to run what I call economics of walking about surveys. They've run these data, and this was done last week. So they do the survey last week and they put it out today, and I've been involved and others have, trying to ask people these questions about the economics of walking about, asking them literally in 3-day chunks and then publishing the data in 3-day chunks. We've never had to do this before. So this, if you like, is the economics of walking about. And this is a question we've talked, and I've written about how many people have lost income. So this is a fundamental thing which we're going to have to talk about, which is that in terms of the recovery, what are people thinking? What are people worried about? What are they going to do over the next 4 weeks? And the recovery is going to depend a lot upon a number of things. We'll call it behavioral responses to this. But obviously, part of it will be, well, what do you think is going to happen to your income over the next 4 weeks? Are people like me who actually turned out, I taught my class remotely. I'm probably going to teach my classes remotely in the fall. The Dartmouth actually says I don't need to come to the campus. Old guys like me don't have to come. Well, if old guys like me don't go shopping, don't go to the mall, don't go to theaters, don't go to sports events, don't go on public transport, this is a behavioral response that's going to have a big effect on the recovery. But just look here, this is the United States taken over the last 4 days. What do you think is going to happen to your employment income over the next 4 weeks? And obviously part of the story which we need to think about is these effects are going to be especially impacting on the least advantaged. So here, 50% of Hispanics think their income is going to be reduced, much more than whites. And obviously it rises at the low end. Look at income. People in the top income group, about a fifth, think their income is going to be impacted, but half of those in the lowest income group. And I think another interesting one is obviously people by education, that's true, and by health. So the people who are in poor health are especially concerned with their employment income, not least because they're staying home and they're worried about going out. And I just want to finish with a couple of things. I think, Martin, I've got about 2 minutes, and I just want to show a couple of slides. But we'll go to this one first. So what's actually happened is that this has had a huge impact on people's sense of self, a huge impact on people's anxiety levels, depression levels. And I just want to point out something to you. So this is a data on life satisfaction that the ONS has been producing for a really long time. And a study run by Andrew Steptoe at the University College London has been asking people, doing the economics of walking about, asking people every 3 or 4 days how happy they are. And actually what's really interesting and sad in a way about the survey is everything's as flat as a pancake. But actually it really isn't. So I want you to look at this. This is the level of life satisfaction since the start of March. And it averages out at around 5.5. So on a scale of 1 to 10, it has an average of 5.5. But actually, if we go back, there's a survey done by YouGov, which actually asks people how happy you are. And it turns out that had a mean of about 50. In the 2-week period before the lockdown, that data series dropped from 50% to 25%, halved in a 2-week period. It's picked up a bit as people become adjusted to it. But to go to this, what basically we can look at in the past, this survey series up to the start of March averaged 7.7. Say it again. So 7.7 life satisfaction points compared to 5.5 life satisfaction points now. So we have never seen anything like a 2 percentage point drop in people's well-being, and it's basically remained flat. So this has really been, an incomparable change. And a couple of things that I'm done. So the economics of walking about is trying to think about what's happened, what's happening to people. So examples, and this is very, very good stuff coming out of all sorts of places around the world. So we just look at people's shopping activity. So you look at their shopping activity in the United States, and it appears that in some of these stores, things are picking up, but the progress is slow. If you look in the UK in the chart at the bottom there, progress it's improving and picking up, but we're going to have to look at shopping and driving and ordering things and going to restaurants, and that gives us an indicator that things are picking up, but recovery is slow. And here's another one, and I'm just going to finish on it. I mean, if you look, for example, so again, I call this economics of walking about. This is normalization of airline traffic, and I think there's 2 bits that is really relevant which we look at. So the first thing is it turns out this enormous drop in the number of passengers. This is true everywhere, the UK and everywhere else, that the number of passengers has declined dramatically and has picked up a bit. Now, if you just do a steady extension to that, you say, well, that will get us back to June 2021. But the assumption that everything's just going to carry on in the simple way may not be right. And the implications of something like this are really big. We've seen Hertz cars go bankrupt. Not least, they had a bad model in that they bought sedans where people really wanted to get SUVs. But the implication of people not traveling on planes was they don't arrive at the airport and rent a car. And so we really need to sort of track that. But I think the prospects from the economics of walking about that we see simple recovery of the kind we've talked about, of that straight line seems unlikely. I'm gonna finish and just say, we've been socially distancing, we're kind of lost in the woods. I'm gonna finish on that, but just say one final thing. The group that I care a lot about, and I think Martin and I are going to talk a little bit about it. Obviously, some minority groups are a big deal, but unemployment has especially big effects and scarring effects on the young. And what we have to think about is all these people who've been furloughed in the United States, they've been furloughed in the UK and elsewhere. Firms bring people back. The question is, what are we going to do about 16-year-olds? And there are about 700,000 16-year-olds in the UK. Let's assume half of them go off to higher education or something. Even they may defer that, but let's assume they do that. Then you're left with 350,000 young people who presumably aren't going anywhere. And the problem we know is that a spell of unemployment when you're young creates a permanent scar. And I know, and I've been talking to the Treasury, everybody's very concerned about this. The scarring effects of this are going to be long lasting. The worry is that especially it hits the young. But I think what we learn is that this is very hard to work out what's going on. Where the heck are we? We don't know. But the only way we're really going to get to it is by doing the economics of walking about. So I'm done, Mark. That was pretty good, 20 minutes.
That was perfect.
Thank you.
But let's pick up on one of the main points. I mean, of course, you are kind of cautioning that many countries don't have timely data. It takes time to really figure out what's happening. Right. But of course, what we do have is overwhelming. So I want to talk a bit more about how this very bad situation is particularly bad for those who are already on the margin. So you've mentioned minorities, you've mentioned the young, and you illustrated that with US data. We do have data from other countries showing pretty much exactly the same thing. So the Resolution Foundation has come out with stuff showing that the people who've lost the most work, either been furloughed at the highest rate or lost hours or lost income. Again, it sort of follows. It's the poorest people, the people on the lowest incomes to start with, who are hit the worst. And I wanted to just kind of give add the historical perspective on this. It's true, isn't it, that in every recession, it tends to be the people in the worst situation who get, to put it simply, fired first and hired last. You saw it a bit in the chart, the time series you showed for Black Americans and average Americans. You see that at the beginning of a recovery, that gap is very big, and then gradually, as the recovery increases, proceeds, you get these people on the margins pulled in. But it takes much longer for them to actually see the recovery coming. Absolutely. And now we see them actually losing out at a higher rate. So it's fair to expect, isn't it, that depending on how fast we manage to get out of this hole, the longer it takes us, the worse it's going to be for those groups you've talked about.
I completely agree with everything you said there. I think the reality, so I always think, say it another way, the people who do worst in the slump are the people who do best in the boom. So think of Black youth unemployment. Yep. It turns, that's the first thing. The second thing is, I think that's absolutely right. But in places like Germany and Holland and Sweden, and to a lesser extent in the UK, the extent to which these groups do worse is less than it is in the United States. Right. So we were talking earlier. If I just do my calculation after we talked, I went and did it 10 minutes ago. So if you just take youth unemployment in the US today, so I just take 16 to 24-year-olds, in the US today, it's 29% already. And obviously, if I do it for 16 to 19-year-olds, it's much more than that. Okay. So in a way, you could think, in a sense, you can think in the US, what the things about Black Lives Matter, you might actually think, well, the first thing in the US is that the virus has disproportionately impacted African Americans already. Secondly, the rise in unemployment already has particularly impacted those groups. I mean, in a sense, the surprise to social scientists like me, and I wrote this some time ago, the surprise to me, in a sense, from 2008 was how compliant people had been. We saw riots in Sweden in 2013, 2011 in the UK. So now what we have is as you say, the whole thing snowballing. And I think the issue is going to be in the US, eventually what happens when we get to a September, October, and these increased unemployment benefits and so on run out, what's going to happen? But I think you're completely right. The situation is true every place. We really need to worry about it. But I think it's going to look much worse in the United States. I mean, so an example, when you and I talked a little bit about it. If you looked in May and the president celebrated the fact that the unemployment rate fell quite a lot overall, but actually it went up for Blacks and Asians, even before you do the adjustment, right? So I think that's absolutely true. But in a sense, I preempted what you were going to say at the end, because I think about the reason I raised the 16-year-olds is that these are people who are out there already. You know, the group you talked about, minorities. Yep. But think about minority, less educated 16-year-olds. If that group, I mean, we've worked a lot about it, and David Bell and I have written a lot about it. If that group doesn't make a foothold in the labor market, I mean, your point is really well taken, but the place where it matters the most is the transition from school to work. So imagine a 16-year-old of the kind you said in Germany, wherever, that 16-year-old, less educated, say they're a minority in Hackney, if you don't get them into a job, into the labor market around the age of 16, or do something positive, the way that economists think of it is, if you don't do that, that creates permanent scars. Whereas a 20-year-old, a 25-year-old, whatever, it's a temporary blemish. So I agree completely with you, but I think the focus has to be, what are we going to do about these kids who will, you know, and so David Bell and I wrote a column in The Guardian the other day about perhaps we should think about a civilian conservation corps. We really have to focus on them. But Martin, I completely agree what you said was completely right.
Yeah, no, I just want to emphasize, you know, underline what you said about permanent scars, because the evidence is it's sort of, it's almost shocking that we know from historical studies that graduating, for example, or leaving school in a recession it casts literally a lifetime shadow,
Yes,
lifelong shadow on your
right.
earnings prospects, right?
Absolutely right. Well, can I add one thing, which is sort of a positive in the UK, and I was talking to the Treasury about this yesterday. The one thing in 2000, it's what you said is absolutely true. The other thing is, in fact, if you graduate or you graduate from school or from college, and the cohort is really big, that has an effect as well.
Right.
The one benefit we have now is that the number of 16-year-olds in the UK is the smallest it's been for 2 decades, and will be the smallest it's the smallest it's been for kind of 15 years, and it will never, and it's the smallest it's going to be for the next. So actually there is an advantage.
I don't want to say clutching at straws, but
yeah, I know.
We should take whatever we can get.
I'm trying to be positive.
So let's talk about policies. Because clearly, it's an enormous recession, downturn, lockdown, whatever you want to call it, and we know these are bad, and particularly bad for the more vulnerable or exposed or marginalized people. What do we do about it? So there are a couple of themes I'd like to cover, but let's start with macroeconomic policy, because you did macroeconomic policy. You sat on the Monetary Policy Committee, right. And you quoted Keynes, and Keynes, of course, was saying, look, you need to make the slump as short as you can and the boom as long as you can. And this sort of debate was happening even before COVID. So I find particularly interesting that Jay Powell, the chair of the Federal Reserve, had kind of come in as we need to normalize monetary policy kind of guy, and then was really impressed by finding that this the fact that they kept interest rates low, kept bringing people into the labor market more than pretty much anyone had expected. Maybe not you. You can tell us about that. But as we come out of this recession, is there a case for saying that we should use aggregate demand policy, be willing to stimulate much more than we have sort of conventionally thought, that we need to pump a lot more demand, either from the monetary side or from the fiscal side, into revving up the economy? How important is that, and what is the risk that that the people currently sort of at the levers become too cautious?
I think there's a huge danger that we've become too cautious. And I think that was a huge mistake in 2010, where the
just after you left the committee, right?
You're talking
about fiscal.
I'm talking about fiscal. I mean, the move to austerity ended up creating. I mean, I've written about it endlessly. The recovery in the UK, because of the austerity, resulted in the slowest recovery in 300 years. Only the one prior to it was the South Sea bubble. So the problem is that you just don't have enough courage. But let's just go to what you said. I completely agree that what we have here is a huge, a never seen before recession. And let's put it in context. The rise in the unemployment rate in the US is comparable to what happened in the Great Depression, which took basically 2 years to happen. Right. It took 2.5 months to happen in the United States. So we've never thought about things where the speed happens like this. I think that there was a huge mistake on the part of the Fed to raise. I oppose that, endlessly. I oppose the 8 rate rises that the Fed made. So be mindful that by December 2019, the Fed had raised rates 8 times, said that in 2019 they were going to raise 3 times more, and in 2020 they were going to raise 4 times more. Yep. So now they got themselves in a position where they weren't at full employment. The economy was actually already slowing when we got to February, way away from full employment, but driven by Fed error. And obviously that's part of the story. And then Powell realized that they got themselves in a complete hole. So now what we have is the unthinkable. Let me put it this way. I remember at a meeting, this is talking out of school, but I'm going to do it because there's no one listening. I remember at a meeting where we started to think about doing quantitative easing. We were thinking we were going to do it, but you didn't know we were going to do it. And we had to plan. It took several months to plan to do it in March of 2009. And I remember a briefing which said the central bank could buy anything. Let's just go with that.
Just for the audience, quantitative easing is when the central bank buys a lot of bonds in order to bring long interest rates down.
No, but it's not that. You see, I mean, it was bonds, and we in the UK we bought we essentially bought bonds, but we also bought some public sector, some public corporate debt, private corporate debt. In the United States, the central bank bought treasuries, but it was actually also buying mortgage-backed securities to help in the housing market.
Yep.
What's happened is that central banks literally now are buying anything.
Yep.
ETFs, stocks, I mean, literally can buy and probably will end up buying everything, anything you can possibly think of.
And they're right to do so. I think both you and I think.
Absolutely right to do so. I mean, the thing is, they don't understand the effects of it. They don't understand what it'll do. What we know it'll do is it'll raise asset prices. And it's not a surprise why Wall Street's doing just fine. We can dismiss the fact that it's a puzzle about why the stock market's rising. It's exactly obvious. That's why they do QE, to raise asset prices. But the question down the road, I mean, so we heard this morning from Bailey said, you know, we're going to have to do more. I mean, with the GDP data that came out. So you're going to see central banks going like crazy. But the question is, how much firepower do they have? How much ability do they have to actually slow this shock? Think of a falling knife. They're trying to stop the knife from falling. The question is, can they do it on their own? I mean, a month ago, people were saying, oh, rates can't go negative. Well, that's gone. The probability is they probably will go negative. And then the question is, oh, they can't go very negative. Well, I don't know. Maybe they can. We'll have to see. And then the question is, what are the fiscal authorities going to do? I mean, go back to the point. The central bank can focus and do things in a general way. If you want to be able to deal with the disparate groups who are especially impacted, let's think about the young, let's think about minorities and so on. The way you're going to get them, you've got to get money to them. You've got to get money to these people. The central bank can't really do that. Well, maybe it can, maybe by helicopter money. The unthinkable, you drop money from the sky, but somehow or other, if unemployment benefits run out in September and the government schemes run out, we have an indicator of what that does. In the United States, so this, how I would encourage people to go to the census website called Household Pulse Survey, and they ask people, how much trouble you have getting food? And the answer is, this is a really big deal. And around the world, especially in the United States, we're seeing food banks, you know, they open expecting 1,000 people to show up and 40,000 people show up. So we're in a position in the fall, the central bank can't deal with food lines, right? So this is really, so we really are, certainly in the United States, this is a big deal. But I agree with you. I think we're now, the way to think of this is a falling knife.
There's another policy issue I want to discuss with you, because there's an interesting difference between the US and I think Ireland, which have sort of, they put a lot of money into unemployment benefits, but they are letting people lose their jobs. And then you've got the model that we have in the UK, continental Europe, Nordics, which is a furloughing scheme where you want people to remain employed, but you're subsidizing the businesses, the employers, to maintain the work relationships for now. And what we've seen is sort of obvious that the countries that subsidize companies to keep people on payroll, even if they don't work, obviously have lower registered unemployment rates. But of course, a lot of people are on these furlough schemes. Now, I mean, do you have those are kind of two different ways of looking at it, partly to do, I think, with just sort of political, cultural and institutional, what they used to, although the UK, interestingly, has sort of adopted a European model and had to make it from scratch. But part of it is about how important people think it is to maintain these links between the employer and the employee. So the idea behind the furlough was, look, we want people to get back to these jobs. So rather than severing the relationship, let's keep them connected. Whereas in the US, they've not gone for that largely. I mean, it would seem that the furlough option kind of seems on the surface, at least, sensible. But then what happens if this drags on for a bit? What do you think about the choice between those two?
I mean that's a great question. I mean, the first thing that the thing that begs, in a sense, is you furlough these people with the assumption that the firm survives to bring the people back.
Exactly.
And obviously, you know, you and I have written endlessly about, you know, people talk about zombie companies. The problem is we don't know which is a zombie company and which isn't, right? So obviously the issue down the road is, well, are places going to reopen? I got a couple of stories I wanted to tell people. So a good example in America is, it turns out breakfast in America is a really big deal, right? Old people go out to breakfast. Well, it turns out old people have stopped going out to breakfast, and breakfast doesn't do takeout, right? So the question is, okay, the furloughed waitresses and stuff at the breakfast place, are they going to come back? Don't know. The second story in the United States, remember, is there's so much variation state by state in terms of the availability of benefits, in terms of the availability of the minimum wage. So I spoke to somebody in New Hampshire, which is live free or die state, guy who runs a limo company, and he told me that he laid off 20 drivers, and his business is now coming back, and he's brought about half of them back, but the other half don't want to come back because they're making more on unemployment benefits than they are as a very low paid variable hours person. And all the things you say are right. And the problem, remember, in the United States, unlike in the places you've talked about, is that in most cases, people's health insurance is tied to their work.
Yep.
And so the loss of work means the loss of health insurance. And this is a really big deal and varies by state. And so the other thing to remember, in a sense, in the United States, is that the incentives to not bail out and to not let people be left hanging is it's a special year.
It is a bit of a special year.
It's an election year.
Yeah.
So what do you think the prospects are that the federal government in October is going to allow people in Alabama and in Florida and in Miami, in Maine and so on, the crucial battleground states? So obviously there's politics to this, but I think you're completely right that these furloughing schemes and schemes to tie people to their workplace are fine. Most hit in the UK, but the problem down the road is going to be if there's a behavioral change. I mean, in Germany, in the UK, whatever, if people don't go back to going out to breakfast, the furlough scheme, you can't furlough a scheme, you can't furlough workers to a firm that can't survive. And that's what's going to impact our recovery. Right? At some point, the firm's going to die.
I suspect that, by the autumn, actually, these two models will look more similar to each other.
Absolutely right.
Because we'll have, there'll be something that needs to be done in the US to bring people back to work. And in Europe, a lot of these companies will have gone bust by then. And, you talk about zombie companies. We could also talk about zombie jobs. Not all of these jobs it'll be possible to get back to.
The question then is, what is the government going to do? I mean, we've talked about the government thinking, we're going to save this company, we're going to save that. But the reality is that small firms are going to fail. And that's quite different in a sense. Remember what happened in 2008? There wasn't that much firm failure. I mean, we didn't see big factories failing. We may well, think of the demand for car. I mean, we may well see the plants in Sunderland and so on closing. So that would be cataclysmic for a particular area. So that's back to the 80s again.
I'm going to take some questions from the audience.
Yeah,
there are lots, so I apologize in advance that I won't be able to cover everything. But I want to start with, there are young people in the audience, and they're very welcome, but they are naturally concerned. So there are a couple of questions, and I'll try and roll them together. I mean, they're basically, there are people who are now school leavers. They are worried, how worried should they be? And one person is asking, do you think that I should now, instead of leaving school, go on to higher education, if that's sort of a choice? Is that the right choice to do for a person who, is sort of maybe choosing between, or would normally be choosing between kind of getting into the work life or going on to higher education? And let me just add a related question. One person asked, I think furloughing schemes should be complemented with retraining schemes, which should be extended to the young, 16 to 24-year-olds unemployed. Do you agree? So, what should the young do? What should we do for the young?
Traditionally, what we see, I mean, just if you look in the data, so that's going to be good data, folks. What young people do when the job market becomes tight, becomes loose, you can't get a job, is they traditionally go to do higher education. Right, that's absolutely what people should do, and what we're seeing around the world is that people are deferring. So my daughter's a admissions tutor to a big business school in the United States, and there people are applying, being accepted, and then deferring. So people are deferring. I mean, the first thing I think the advice that you would give would be, do whatever you can do to avoid being unemployed.
Right.
Do something. You can't really go on the road like you can't. A gap year in Germany is not really on the cards. So everything you can do to fill your CV out saying you've done positive things. The one concern for young people is that you really don't want them to be unemployed. So we've actually been thinking about, so Martin, here's a little example. So one possibility is this Civilian Conservation Corps. That was what happened in the 30s. In fact, it was about trying to help in terms of the environment. It planted 3 billion trees. One possibility, which we've actually been talking to universities about, universities have got a big hole. Their big hole is that students from abroad haven't come. They have a funding issue. We've been talking to a number of university principals. The possibility is that perhaps these universities have got the capacity to start to think about training people and helping as part of this scheme to get these young people doing effective things. Think about, clean the oceans, plant trees, do effective stuff. But one possibility might be we actually have the capacity because these universities they've got a shortfall of money and the students haven't come. So we've been trying to get this scheme underway. But the idea that young people should be doing worthwhile things, and there's lots of trusts and agencies that need supporting. So the Prince's Trust, all sorts of things like that. So positive things for the young to avoid a spell of unemployment is 100% what people should be doing. And I think the universities have to get in on this. If you think of it, they got the classrooms, they got the staff, they know about organizing things. Don't whine and complain that you haven't got foreign students. You've got 350,000 16-year-olds, sort them out.
All they need is the funding from governments. Right?
Well, I think that's right. Right. But at the moment, they're asking for funding from government. So the obvious thing to do is you've got the capacity and you need some money, and we need to fund these kids. Go sort them out. So there's a practical. But I agree. The young, it's a bit. But I'm central to this. David Bell and I have written. I wrote my master's thesis in 1981 on youth unemployment, and I never wanted to see it come back again. So I'm the guy.
Let's talk about the longer term then, because there's another question. Which is what are some of the structural reforms we can expect or maybe want governments to take to deal with unemployment? And I think that's a really important point, because we've talked basically about the short-term measures, push demand up, find ways to keep the young from falling into unemployment. Anything is better than unemployment, basically. But these are short-term policies. So what about the longer term?
Well, I mean, the word I wrote down was vulnerabilities, right? So in a sense, the problem is that it's a bit like you prepare yourself for the last shock. So let's think back. Why did the UK and the US get hit so hard in 2008? Well, there were two reasons. We had a financial market shock and we had a housing market shock. Well, the UK is overly dependent on the financial sector. So when a financial market shock, the UK and the US gets hit by a financial market shock. And then second, it overexpanded the housing market. And I remember coming onto the NPC and looking at people making speeches saying, this was completely fine. I mean, you looked at house price to earnings ratios. They've been 3 for 100 years. They were 6 in Britain and 14 in London. Well, guess what? That made the society vulnerable. I think what we've done, in a sense, go back to the austerity point. What did austerity do? It made the health service and communities more vulnerable to a pandemic and to a shock than they should have been, right? The communities. You took away community policing, which has happened in America, but then you ended up with riots. You weakened the National Health Service. You didn't build buffers into it. So I think that the big thing we're going to have to look at is the role of the state. And you've written about all this stuff. Your work is a great deal about this. You're the expert on this. It's a great question. You should answer it. No, you're completely right. But I think the story I would say is you have to think about where is the shock coming. So in 2008, it came from the financial markets and housing. In 2020, it's come from a pandemic. But it wasn't as if a pandemic is unexpected. I read this great book called The Great Influenza, and it's all laid out there. And so what you did was you made the National Health Service, you cut it to the bone. You weren't ready for things. So I think what we have to reconsider is the size and the role of the state. And it's over to you because you wrote a book about it.
Thanks for the invitation, because this allows me to abuse the host. I'll show this to if anyone's interested.
No, let me
Economics
just
of belonging.
say this though. And what the stuff that was used in 2010 the argument made that you shouldn't allow the debt to GDP ratio to get above 90%.
Yeah.
Turned out to be completely wrong, probably fraudulent.
Yeah.
Right. And in fact, there's a famous study done by a guy called Thomas Herndon, who showed that it was basically just an error. I mean, a spreadsheet error. And in fact, there was no evidence for that whatsoever. And the evidence is that, you know, higher debt to GDP ratios in many senses, particularly post-war. If you look back at World War II, in places like the UK and Australia and so on, what happened after World War II is you had huge debt to GDP ratios, and that generated high growth.
Yep.
And so I think we have to. Well, you go. You can tell us about your book. Give
No,
us the figures on the book.
No, I was going to say.
About.
I was going to say. I want to stick to this question of sort of long-term structural change because one thing we've talked about is how do you get unemployment down and jobs back. But the other question is which jobs are we talking about? So you know, one thing I focus on in my book, and you have written about it in the past, a lot of the jobs that we had before this crisis were really bad jobs. They were badly paid. They were insecure. Unpredictable, and this is part of what's so heartrending about this crisis. That not only has the effect been very unequal, but the people who hit the most actually had a really bad situation in the first place.
Yes.
And now we have on top of that some of these jobs just can't come back. Jobs in hospitality, for example, will be affected by public health measures, social distancing. So
barmaids.
We already needed to try to shift people from bad jobs into better jobs, and that's even more important now. So what are the sorts of things we should think about? I mean, I have my thoughts is that we need to kind of force businesses to shift from relying on low productivity, low wage labor, and try to become more productive. So, you know, I have the slightly heterodox idea that this is a good time to increase minimum wages, for example, to force companies to make jobs productive enough to pay for it, matching that with high pressure demand to ensure that there are enough jobs in total. But you probably have some views about how we get away from bad jobs, and when people return to work, they return to better jobs than before.
So let's just, people have asked me over the decades, you know, where are the good jobs going to come from? And I say, I don't know. Because if you look back 20 years, you know, think where you were 20 years ago. Could we have predicted iPhone? The answer is no. Second thing, I think, particularly in the United States, we're going to have a rethink about the minimum wage. We're going to have a rethink about how we value people at the low end. So think about people who sweep the floors and clean the floors in hospitals, people who deliver things, people who have fundamental services. So I think the first thing is that's we're going to reconsider the value of those people, because the value of them, I'm prepared to pay more for them because I hadn't really understood how valuable they were. So that, I think, is the first thing. Second thing, relative to your point, the evidence on the minimum wage is that actually a higher minimum wage doesn't produce bad employment effects. And if anything, it pays for itself through higher productivity effects, right? So what happens, I mean, the standard work in the United States is that if you pay a very low minimum wage, the people, on average, people stay for 6 weeks. As you raise the minimum wage, they stay longer, and the cost of training them can be amortized over a longer time period, right? So the question,
you'll train them more.
You train them more, and they become more productive. But I want to go, and I want you to respond to this. I think, and in fact, what's happened is that the whole thing about subsidy and your point about raising the minimum wage, in a sense, why we've seen this move to capital is simply an economic choice. The reason that people go to capital is the relative price of capital is lower, right? Which means the relative price of labor is higher. So let's switch the subsidy, which is the way to do what you want. You can make labor cheaper by changing the incentives. We give all the incentives to impose capital. Well, that doesn't help very much. So let's give firms a greater incentive to hire people. That generates a higher minimum wage. You train them more. You make them better. Give firms incentives to train. The choice of where you are on the capital labor mix is a choice. So we can prevent people's jobs being overcome by capital by making capital more expensive and labor less expensive. That doesn't mean you pay labor less. It's just, I think your book and the way I've thought about things is that we've realized how crucial labor is. Labor in a pandemic. think of what the folks have done. They go to work, they get the food for you, they sweep the shelves, they do all of that stuff. So I think as a society, we should start to value labor more and change the relative mix of capital to labor. So to accomplish what you want, you've just got to take the subsidy of capital away and subsidize it to labor. You get the same output, you just get better jobs and higher paid jobs.
And one way of doing that is to reduce the tax wedge on labor, income taxes, social security, and so on, and then impose taxes on capital, whether that's profit taxes, wealth tax.
Well, you could also think of it as subsidy, right? A subsidy is a negative tax.
Yeah.
I mean, you could do it either way around, right?
Absolutely.
You could say to a firm now, we'll give you $5,000 a year. I'm making it up, £5,000 a year tax deduction for each 16-year-old you hire, or something, right? So you could do it as a negative tax. You could do it by reducing taxes, or you could give firms subsidies, and that would not be a crazy thing to do. And that's what we haven't done, because we've gone down this austerity, small state thing, not value people, and then we've generated this huge incentive to pay CEOs a huge amount of money. Well, look at what that's done. It's generated riots. So we have to deal with the inequality issue too.
If you look at what the Nordic societies have done over time, of course, they have, compressed the wage distribution. Yes. The unions have done that, but a high minimum wage could do the same, for example. And the result is, in a sense, you get better labor and more capital, because companies invest more to make that labor more productive. And then you have other policies, skills policies, education, that sort of thing, so that people are equipped to take more capital-intensive jobs.
Right. Well, I mean, I just think that there are models out there that we can use, but we have to learn. And I don't think you disagree. I mean, what we've talked about is that you've made society vulnerable to a shock. Sometimes, each time around, it's a new shock. So it was a financial market shock. Now it's a health shock. Well, what's the next one going to be? It could be another health shock. But you have to make yourself vulnerable. And the lesson we have to learn, surely, is that people are really important, and perhaps society hadn't realized how important people at the low end are, and we have to, the society has to take out. I think the great line is the father's sort of tender loving care, and we have to take care of them more than we have. Homelessness, people on the street. How do you self-isolate if you're homeless? There's a good example. We don't need that anymore.
We're almost out of time. So there were a number of questions that I won't really ask, because we don't have time, and you've almost answered them already. But they're basically about, how does this change the whole social model, the standing of the West? The sort of huge question that kind of goes beyond what we know as economists. But just to kind of pin you down on what you've just talked about, because you suggested we will actually change our attitude, and you suggested there is now the space for some pretty radical economic policy changes. So I'll just ask that question by asking, in a sentence, how confident are you actually that we can make a big change, versus is this a sort of fleeting moment of recognizing how important these people are, and we'll lose it? And
I don't know the answer to it. Obviously, I don't know, but I have a sense, certainly in the United States, that this is a moment. I mean, obviously, we've seen so much in the last 2 weeks, and we've seen the army chiefs standing up. We've seen all kinds of stuff. We've literally seen 4 chairmen of the Joint Chiefs standing up. We've seen religious leaders standing up. And what we've seen is attempts to say this is about violent protest. But actually what's happened is that tens of thousands, hundreds of thousands, millions of people have silently protested. We've never seen that before. We've seen riots. I've documented riots in Britain, right? There were riots all over Britain, started in London, it spread around London, went to Berlin. But there weren't peaceful protests out there supporting them. These were violent protests. But what we have is suddenly, we've seen protests in London, in Sydney, around the world. So I have a sense that the quiet protest is something we've not seen before. So that suggests people have stood up and said, there's something wrong here. And the moments like that, I think, are important. So I don't know, but it feels to me a great moment.
No, to me, it also feels like it could be a 1945 moment, a 1933 moment, but it depends on the political choices of people people in our audience, to whom I now turn to just thank you all.
Thank you.
This event has been recorded, and the recording will be available on the York Festival of Ideas YouTube channel. It'll be a couple of days apparently before it might be ready, but do, if you want to watch again, or if you want to share it with people who couldn't watch it now, please do so. And I'm also asked to do some self-promotion. If you want to purchase a copy of either David's latest book, Not Working, Where Have All the Good Jobs Gone, or my latest book, The Economics of Belonging, show your book, Danny, if you have a copy there.
I don't think I got one here.
They are available.
Yeah, I do. Yeah.
Very good.
I do. Hold on.
There it is, Not Working. See, same color scheme, so they're obviously both good. They're available from the festival's partner bookseller, Fox Lane Books, and there will be a link to that from the festival website, or you can go to foxlanebooks.co.uk/festival-of-ideas. And if you enjoyed this talk, you may enjoy a talk tonight, Syzygy Live, The Mystery of Dark Matter, which is at 8 p.m. And with that, I'll just thank Danny for joining me.
Thanks everyone
for sitting, listening in, and asking questions. And thanks to the festival for hosting us.
Thanks, guys.
Have a good day and a good weekend.
Take care. Thank you.
Thank you.